More with Ajay Tyagi, our next guest on the show. He's head of equity at UTI Asset Management. Ajay, great to have you with us. Good afternoon to you. So, let's start right there. PSUs were the poster child of the poster boys and girls of the rally up until we hit the peak in September last year. But at least some of these PSU pockets, defense, for instance, there's still a lot of interest. Railway, like my colleague Nimesh was saying, still a lot of interest. How are you positioned overall on PSUs in your portfolios? And within that, specifically defense and railways, what's the advice?
Yeah, I mean, I can't be too stock specific, but, just to give you the broad thought process, see, rather than getting sucked in by narratives or, certain part of the market, perhaps just because that part of the market is undergoing some very positive momentum or a strong momentum, we always try and evaluate businesses from a 3 to 5 year perspective. Whether they are a PSU or they are not a PSU, if the business prospects remain strong from a medium to long term perspective, we always get excited about these opportunities. And when I say prospects look good, we should be able to witness this in hard numbers in terms of profitability, sustainability of margins, generation of cash flows, and so on. Having said that, out of the list of industries that you just spelled out, there are a few companies in the defense sector which we think have a fairly strong business model going into the medium to long term. And yeah, I mean, possibly that's the reason why we would be keenly evaluating them. Yeah.
Got that. Mr. Tyagi, hi, afternoon. This is Rima here. You're also getting constructive on the consumer discretionary sector and even consumer durables at this juncture. Now, if you remember post-budget, on the back of the government stimulus, there was so much optimism. Stocks did well, but the rally faded. Do you think this time it's going to be different and it could be a structural up move in consumer durables and discretionary?
Well, that's our base case right now. We think that over the last few years, the consumer demand has been very weak. And see, like any other industry, even the consumer demand is fairly cyclical. I mean, it remains strong at a point of time, but then weakens, forms a trough, and from there it starts to strengthen once again. So if you look at these patterns, number one, we are tempted to believe that after a very poor last couple of years, because of a variety of reasons, of course, disposable income was under stress, inflation was high, and so on. From that trough, we see consumer demand picking up. That's point number one. Point number two is that, of course, the government, one way or the other, is putting money in the pockets of consumers at large. Now, income tax cuts were obviously one way of, putting more money in the pockets. But we've also seen various state governments also roll out certain welfare schemes. So at the aggregate level, this does add up to a meaningful amount, which can help, perk up this consumer demand, which has been weak. Last but not the least, falling interest rates certainly are a positive for the discretionary end of the consumer demand. So all of these factors put together, to our mind, only bolster the case for better days for consumer-related sectors in the coming years. Yeah.
Okay, so consumer, you're saying could be something worth looking at. The other, of course, point of discussion today is financials. Last couple of days, actually, because of this easier monetary stance that we've seen from the RBI, rate cuts, CRR cuts, and many feel that maybe we'll still get another 25 bips, maybe not in the next policy, maybe down the year. So in this environment, what do you like the most? And it's a vast universe. So private banks, PSU banks, NBFCs, give us some sense of how to play it.
Once again, I'll take you back to my reply to your first question. We are usually, rather than just bucketing them as private banks or PSU banks, we just, look under the hood in terms of what is the business looking like for each of these banks, whether private or PSU? What has been their track record in terms of A, growth, and B, controlling credit costs? And see, this is very important because in terms of banks, we are not only looking at growth, we are also looking at how their balance sheets would shape up, whether they will remain strong or are there chances of accidents? What's the credit underwriting capability? What has been the track record and so on? So, if you were to weigh in all these factors, we are tempted to look at private sector banks, more favorably. The other reason is, of course, their valuations still continue to be at or below their long-term averages. Do remember, we are talking about a market where valuations are at least 20 to 30% higher than long-term averages. And in this scenario, if there are institutions, if there are banks which are actually trading at or slightly below long-term averages, it just tells you how attractive they are purely on valuations. Of course, CRR cut is going to throw in huge amount of liquidity into the system, which is only going to benefit these banks over time. And we strongly feel that there is a case for credit growth in India remaining in double digits, in low teens numbers for a protracted period of time. Yeah.
What's the broader market call for the second half of the year? And you're also recommending a balanced advantage fund or a multi-asset allocation fund. Why is that?
This is purely from our view about the valuations at which the markets are trading right now. Like I mentioned, everything is expensive. Of course, we find the mid caps and the small caps to be significantly higher than what their valuations ought to be. So that's the part of the market which we are very cautious about. I would say even large caps are not trading cheap, but on a relative basis, they are better off than mid and small caps. So, we find valuations to be expensive in each and every corner of the market. And because of this view, we are advocating, hybrid funds like balanced advantage and multi-asset funds, because we feel that at this juncture, the most important thing is downside protection. Which brings me to the first part of your question, which is that our view is cautious on the markets. We feel that markets, which made a peak in September of last year, may continue to actually consolidate for some more time. Now, it's very difficult to, forecast these things, but our view bases valuations and also our view on earnings growth over the next couple of quarters brings us to this conclusion that we would see more of consolidation in the coming quarters. Yeah.
Okay, so you're expecting more consolidation. Ajay, since we've seen pockets, I mean, the mid caps have come back quite a bit throughout April, May. We've seen a big pullback in mid caps. Are there any pockets of the market where you see a bit of, risk building up again? I mean, would you advise lightening positions anywhere?
See, I think the what we call as the high beta part of the market has once again started to move up, and it's moved up very sharply in the last almost 2 months. I mean, the rally started sometime towards the beginning of April, and it has been going on unabated. So the high beta part of the market is certainly looking overheated, and that's where we would be cautious. Now, this is across many different sectors, but I would say in general, the narrative stocks, as you call them, are the ones which we are most cautious about at this stage.
Cautious about narrative stocks, cautious about the markets also on the whole, and valuations of the small and mid caps are pretty high right now. Ajay, thank you very much for joining in. We'll get into a break on that note. On the other side, we'll get you a check on what dealing rooms are saying in our segment, Day Street Chatter. We'll also get you a few BTST calls. Stay tuned.